Welcome back. I am here to talk about one of my 4 covered call strategies that I have in my Millionaire Mentorship program that I am giving away for free here on YouTube this month. And it'll stay up forever, so aren't you guys lucky? So we are going to talk right now about the classic covered call that everyone likes to sell on YouTube, that strategy, which is selling the 10 or 20 delta. It's my least favorite strategy, because I don't think that when people trade this, they're thinking like traders. And I am a trader and I use options to make an income. And so I think there is sort of like a real problem with trying to think about your trading as though you are also an investor at the same time, okay? And that is kind of what this trade instills in people, is the idea that you can keep your shares and you can get extra income after the shares while you own them, and everything will just be fine as long as you're selling a 20 delta. I'm here to say everything will not be fine as long as you are selling a 20 delta. This covered call is a very powerful tool, very powerful. But I just want everyone to understand the ins and outs of it and what is at risk and what's not. So let's get into it. Again, we are here in the next 4 weeks. This is week 3, where we are discussing these different strategies. And today we are doing the riding the stock up strategy. So that is essentially where we are selling a strike price on our covered call that is significantly more than what the stock price is today. And hopefully, obviously, a lot more than what the stock price is that we bought the shares for. Okay. There are also these other strategies that are coming out every week now, and you can go back on my YouTube and watch the ones that are already out. But at the end of June, all of these videos will be out there and you'll be able to enjoy all of them. Okay, so let's get into this riding the stock up to collect some income as we are holding these shares, because that's the idea of this, okay? This strategy involves buying or trading a stock that we already own and want to try to keep. We want to try to keep these shares, okay? I want you to understand, though, that you should never, ever sell a covered call on a stock that you're determined to keep, because the market moves quickly and we risk having our shares bought away. So once you commit to a covered call, you commit. Like, it's under contract. No complaints later. Like, I see people say this, like their complaint will be, well, I'm selling covered calls and then I'm having to buy the contract back because I want to keep my shares. I don't want to make this massive cap gain. Okay, well, that's what you committed to do. That's what the contract said. So why did you do it? You know, you did it probably because you were greedy. I'm not saying that like, oh my gosh, you're a greedy person. I am saying that you made some decisions that are then causing financial implications for you that you didn't want. So let's think about those before we make the trade. And maybe not trade to begin with. That's another thing here. Okay, so that's one of the things that you need to consider on this sort of strategy is, do you even want to do it? You may not, because if you want to keep your shares, again, I'm just here to say, I've always, I've done this many times and my shares are always called for me. Do you know why? Because I make great stock picks. And if you make great stock picks, that stock is going to zip off on you from time to time. And the other thing that I won't do is I won't buy calls back. So you can see, I'm all for losing the shares once that stock rips on me. And I'll explain why later. Okay, but more about this, okay? The riding the stock up strategy. In the strategy, we examine, here's where I'm going to be different from everybody else on YouTube. They're going to tell you to pick a 10 or 20 delta and everything will be fine. Everything won't be fine. Everything will not be fine. We're going to do it a different way. We're going to do it my way, which is we're going to examine the stock chart and note the price that appears to be likely to be outside of the range that the stock can move when it's under the contract. So we have to do a quick chart read. We do not have to be chartists, but we have to reference the chart in order to make an educated decision on how to move forward. And when I say educated decision on how to move forward, that chart might tell us we're not moving forward, and we have to be okay with that, okay? Because there's never any guarantee this stock won't rise and be called away, but we can make educated guesses that will be right most of the time, okay? The goal here with this trade is to take in some premium, although notably less premium than my fast money trade that was the first trade in this covered call series. This is because we pick a strike price that's further out from the current stock price, further out of the money, as people like to say in the stock world. And we're allowing the stock to move up without those shares being called away, hopefully. The goal is to, again, allow the stock to appreciate over long-term time, hold a long-term hold, and generate income from the premiums as the stock values increases, right? I mean, wouldn't it be a beautiful thing to have held Amazon at $74 all the way up to $200 and have collected like $100 every month as it rose? It would have been beautiful. Would it have been hard to do? Probably. I'm just here to say it probably would have been hard to do, especially if you didn't have a good education and rollouts. Okay. So again, other YouTubers are making just a mistake of selling the 10 or 20 delta on their covered calls as a general rule of thumb, and it's a terrible idea. There's a much better way, and that is to reference the stocks chart. So let's go see what I'm talking about on Meta, okay? So the reason it's a terrible idea is because stocks pull back, okay? And we just recently had a very dramatic pullback because of the tariffs. And so what I will do when I'm going to sell a covered call, that is this riding up strategy, is that I'm going to pull up a 1-year chart of the stock, and I'm going to see what the all-time high of that stock was. And in this case on Meta, it's $736. And that was on February 14th, 2025. It's now May 30th. So we're in a situation now where the stock fell off dramatically, and it's now retracing off of this April tariff horror show that we had. And now it's kind of coming back up. Okay. So we're going to go to the next page and we're going to see a little bit more detail here. So one of the things though that I want you to understand about Meta and some of these other best stocks on the market is that 736, that all-time high, a breeze can blow in and these guys can just rip right up back that fast in just like 2 weeks, 3 weeks, whatever. It's crazy when they retrace, okay? Once the sort of like threat goes away, they just pounce and bounce right back up. So there's a little bit of FOMO that goes on in people's mind when there's a sell-off, and they start to get afraid. They start to go, oh, you know what? This stock dropped down to 484 was the low. And if you're holding Meta shares that were worth $73,000 and then they all of a sudden are now worth $48,000, which is what happened here, you as the holder of these stocks might be you might be a little cranky that day, which would be normal, right? I mean, like nobody loves this kind of thing, but you might just be sitting here and saying, I don't think that stock is going to bounce back anytime soon because the world is just crappy right now. And so I'm going to sell a covered call for a 20 delta and take in some income while these shares are down. And that would be a mistake. Okay. Because the best stocks on the market can just rip up once the market changes. And all that had to happen was for a court to rule that the tariffs were off, or somebody to say, hey, these tariffs aren't on anymore, or they're going to be cut in half, or anything. Anything could have happened, and employment numbers could have come in really amazing. Like there's a lot that can just pump the market out of the blue. Inflation could have come in really, really low. Boom, the market takes off. Then you're in a heap of problems, aren't you? So the cost for Meta today is $634. Okay, so I just want to go back here and we're going to go look at how the high was 736 and the cost for Meta today on May 30th is $634. So if we sold a 20 delta today with 3 weeks till expiration, we get $520 in premium. And I don't feel too bad about that trade. Here, let's look at the options chain and I can just show you. We've got a sell call June 20th. That's 21 days, 520 in premium, and the delta's a 22. So there wasn't a straight on 20, but there was a 22. So I went with that, okay? All right, so if the stock moves up on this trade, we can roll up and out and manage to keep these shares. This is because the cost for Meta isn't too far off the all-time high, and selling the 20 delta here, it's not like a terrible idea. Yeah, can Meta just rip up to that 720 right away? Sure, it can. It definitely can. But we might be able to kind of keep up with it because when it hits that 720, there's going to be some resistance there. And just because of the time of the year we're in, if you guys come on my Millionaire Mentorship Program, we're going to talk about seasonality and sort of that sort of thing where you can learn more about that. But let's not. And let's just keep it on the fundamentals of this trade. Okay, so we could probably roll out from there. And just if we really intend on keeping these shares, there's a good chance we could keep our shares. But let's now look at what would happen if we sold the 20 delta off for the April dip and we do a 20 delta here, okay? So the stock moved from April 21st to May 5th by $114 move to the upside in 15 days. Remember, we sold a 3-week call, so we're at risk here. That other trade that we did only had we got the 520 in premium. It only had a $37 swing in it to get $520. This move that we're talking about here, $114. So if we were in this trade and we wanted to keep our shares, we have to be able to roll. And that's extremely difficult on a $114 swing. And guess what, guys? That swing wasn't over then. I put my little cursor here in this little box here on the first box on the left. That's where $5.99 was, which was the $114 swing. It went up like another $50 from there. So there's just no way we could keep up with rolling this out unless we want to roll out for 2 years from now or something silly like that. And why would we want to tie up our cash that long? Because Meta's probably in 2 years going to be worth a way lot more than 780. Okay, that's just the way that the stock chart is going. So what would we have to do here? We'd either have to let the shares be called away from us, and if we bought them for less than less than what the strike price is on the 20 delta, then we're at a loss. So that sucks, right? If we are below the strike, if we brought those shares below the strike price, we're okay, but we don't get to keep our Meta shares. I could live with that. And you should be able to live with that too if you did that trade, because that's not a terrible outcome considering what happened. And then the third option is you buy your call back. And that's going to cost thousands of dollars, like thousands and thousands of dollars on Meta, maybe like $5,000 or something, like $3,000. There's no way I would do that if that happened to me. No way. I try to roll out. I try to make it better. But this is just a terrible situation. If this has happened to you, this is a terrible situation. You have to make a decision here. And it's not easy. So this is not good. This is why I hate 20 deltas. Sell options off the charts, guys. Not off deltas. Okay? All right. So how do we avoid this situation? That's really what we need to get into, because most of trading is making a good choice to begin with, and then the other half of it is managing the trade afterwards. So the first thing I would say is, number one, don't blindly sell 20 deltas. Look at the charts first. Sell 20 deltas on up days only. Does that mean that your shares are sometimes sitting there without any covered calls in the middle? Yeah, it absolutely means that. But your first goal is to keep your shares, isn't it? So being that you're putting your shares at risk, don't you want to put them at less risk? And selling them on all-time high days or high days puts them at less risk of being called away. So like, you can't have your cake and eat it too on this trade. You just can't. It doesn't work out. I've tried it. Okay. And I'm only telling you from experience because I love you and I don't want you to make the same mistakes as me. Okay. So when when a stock does hit an all-time high and you sell that covered call with like a 20 delta there, you may even be able to be more aggressive with the delta that you're selling, because typically when stocks shoot off to a new all-time high, they come back down to earth a little bit. Especially on these sort of like Mag 7 stocks. The high flyers do not. Like the Palantir, no. Like the HIMS, like no. Like there are some certain stocks that just once they get flying, they get flying. But the quality sort of like monopoly name brands that have been around for decades and we know are in the next decade going to be still huge names, they normally don't like have these massive swings and then like never come down after they go up dramatically. Okay. But never say never. You always have to be prepared for that when you sell a covered call. The second thing is, how do we avoid this situation? Don't sell covered calls on stocks you really want to keep. It's more than likely that you will lose them at some point or time or have to buy back the contract at some point in time. I never buy back contracts. Never. I am never going to invest more money in a stock than what I paid for the shares. It's just my rule of thumb. It works really well. I hate when I hear traders are buying back calls. The only way that I will buy back a call is to roll it out. And when I do that, I always consider the opportunity cost of how long I'm rolling that call out for. So if I have to keep shares, if I have to roll out for like a year, there's no way I'm doing that. No way. 6 months, no way. I'm not trying to keep my shares that long. Like, there might be an occasion I'll do it, but like in general, you shouldn't have that be your motive, your strategy. It should be that cash should be coming back in your account as soon as possible. Okay, so the only way that I'm going to buy a contract back for the most time is if I'm doing a rollout. And usually my rollouts are 3 to 6 months max for me to keep a stock. Otherwise, like, I made a bad trade and I'm just going to move along. Okay, and I'm going to take what happened to me. Number 3. You need to set aside money specifically for options trading and a separate amount for investing, okay? Do not trade your investments because you'll get FOMO when they get called away from you and you'll be crying. And do not think of your options trades like investments. Don't be attached to the shares that you trade options with. It is called stock trading for a reason. That is because you're trading money for shares and shares for money. So there's a lot of people who are like, oh, I'm trading covered calls on Amazon and then they're going to get called away from me. And I'm like, yeah, so you made a profit on the shares and you made premium. What more do you want out of life? That's a great situation that you're in. Be happy. Take the money. If you're a good trader, there should be other opportunities before you that you can take. If there aren't, call me. Learn some more things. I would be happy to teach you. Okay. And then number 4, have a strategy. Okay. So a lot of people just aren't comfortable with the consequences of things when they happen, when they're going to be called away or something like that comes up, because they never really thought too much about the overall strategy within their portfolio at large. Okay. And you probably need to think about that. You can even think about your portfolio like it's divided into sections, like certain sections are for different covered call strategies. So I have 4 different covered call strategies, right? And you could divide up your portfolio into using 3 of them and say 30% of my capital I'm going to use on this type of trade, 30% I'm going to use on that type of trade, and 30% I'm going to use on that type of trade. That's a really interesting way to diversify an options trading portfolio. And it's something that I do myself. But for example, in my 401k strategy is this. I trade covered calls on high days to bring in income on the stocks that I own to grow the account. I use that income that comes in to buy more shares in quality companies that I want to hold for like the next 10 years. I sell 20 deltas on the high days, and I don't mind if the shares are called away from me because those shares will have a significant cap gain on them. And I also won't be taxed on that gain. So this is like a win-win for me. Okay. When shares are bought from me, I'm like, not sad. I just sort of say to myself, okay, what other quality stock could I buy to sell covered calls on when a 20 delta right now that are potentially on sale, like which stocks are on sale? Or I simply wait for that stock that I got kicked out of to drop, because normally there's a drop coming after there's a rise. And I buy back the shares, I wait for them to rise again, and then I sell cover calls again on a 20 delta, and it's a beautiful system. And I use this quite frequently. So guys, this is the strategy, okay? I just want you to be aware of the risks here, what the strategy promises, and what it doesn't, okay? So hopefully you learned something. Again, my thing on this trade is like, charts are our friend, charts are our friend, charts are our friend. If you're gonna use a 20 delta, use it on an up day. Don't use it on a down day. When you're having a down day, just don't do anything at all. Wait for the stock to rise.